Welcome everybody to our class today, and what we're going to be talking about is budgeting. As a managerial accountant, you'll find that you do a lot of budgeting. It doesn't even matter what department you're in, you're still going to have to conform somewhat to a budget. So let's first start talking about the types of different budgeting. Really, you've kind of got two categories that I want to discuss. You've got static budgets versus flexible budgets. A static budget is a budget that gives you a budget based on you making one level of inventory. So let's say that you're trying to decide what the budget will be if you make 1,000 units of hats. Well, that's fine and great if you make 1,000 units of hats, but that's not so great if you make 1,500 units of hats. So the idea is with a static budget, it's a budget that doesn't change based on levels of activity. So many times you see a static budget as a budget of a department or something like that. So for example, I work in the business department. The business department would have one budget throughout the year. It doesn't change based on levels of activity. It is based purely on the expenses that we expect to spend that period. So a static budget is just fine, but it's not something that you would necessarily use for production. It would be something more that wouldn't change based on the levels of production. Now, there are two ways you can prepare a static budget. A static budget could be prepared based on an incremental or zero-based plan of action here. So an incremental budget, what it does is, let's say you have a budget in a department, whatever department you might work in, and it's got a certain amount of money that is being budgeted to you. Let's say that every year we expect the costs to go up, cost of living and such to go up, so we increase our budget across the board by a percentage, whether that's 1% or 2% or 3%, it's whatever we decide it is. So with that, we take all of our current budget costs and we apply maybe a 1% increase to everything. That's called an incremental budget because you're changing it by a certain increment. You're changing everything by the same amount, basically. Now that budgeting's fine and it's very quick to do. It's simply taking last year's budget and changing it by a percentage. It's not a very good budget to use though, because with an incremental budget, your problem is that you're not really looking at the lines individually year by year. You're just saying, well, this is what our budget was last year, so this is what it should be this year. Well, this is different than a zero-based budget. Let me explain what that is, and you'll see why a zero-based budget is a better way to budget static budgets. A zero-based budget starts from zero each year, and each year you analyze what are your true costs going to be this year. So every year you're forced to take a hard look at your budget and make sure that it really makes sense. Whereas an incremental budget could be done in minutes, a zero-based budget would probably take a day or a couple of days maybe to prepare and be accurate. So with that, zero-based budgets are better for your business, but incremental budgets are easier. So a lot of places that have these static or non-changing budgets tend to use incremental just because it's quick and easy. But a business that's run better is using a zero-based budget. Now let's talk about a flexible budget. You had static. Static means not changing versus a flexible budget. Well, a flexible budget, what that means is you adjust based on levels of activity. So this is something that you're going to see more in manufacturing, and this is really what we're going to be working on today is a flexible budgeting system. What would happen if you made this many units of product, or what would happen if you made this many? So it changes based on the level of activity changes, which is better for you because think about when you're doing a budget. You're probably doing a budget a year or more before you actually have the year that the budget is in question. So you'd be doing your 2012 budget sometime during 2011. Meaning that things are going to change. You may decide you're going to make more or less of a certain product. So the idea is that if you make 1,000 or you make 1,200, you have a budget that corresponds to that unit of activity. So with that, a flexible budget is one that we're going to be focusing a little bit more on. One thing I didn't mention is that whether you're using static or flexible budgets, they could both be based on the incremental or zero-based budget method. I'm sorry, I was phrasing it more that static could be incremental or zero-based, but really static or flexible budgets could be incremental or zero-based budgets. Clearly, again, the zero-based budget is a better way to go regardless of whether you're preparing a static or flexible budget because you're not building in any inefficiencies from prior years. Each year you're looking at everything with fresh eyes. So with that, a zero-based budget is definitely a safer way to go if you're trying to run your business properly. Now, if you were in my live class, what I would make you do is I would make you come up with a budget for me. But since this is probably for an online course that you're listening to this, your budget, I just wanted to give you this little bit of a visual, which is basically what a personal budget should look like. Your housing should be about 30% of your pay, and your savings and entertainment, and pretty much how, it's a good guideline for how you should be budgeting your own things, your own life. Like I said, if you were in my live class, I'd make you prepare me a personal budget, and I'd make you prepare me a projected budget for what your future will look like. But luckily enough for most of you listening to me, this is an online course, and that's not one of my requirements. Although it is definitely a good thing to do. Alright, so some of the budgets we're going to be looking at, and I'm not even entirely sure we're recording here. There we go. Sorry about that. Little recording quirk. So some of the budgets we're going to be looking at, a business, we're going to be preparing some of these budgets. You kind of got a master budget, and a master budget is a bunch of budgets that get linked together. So the ones we're really going to be focusing on is we're going to be looking at a sales budget, we're going to be looking at we're going to be looking at a production budget, direct materials budget, direct labor budget. We're not going to really look at the factory overhead budget so much, and we're going to look at the cash budget a bit. But really where the majority of this chapter is going to be focused is going to be on this sales, production, direct materials, direct labor piece of it. And what we're going to do is we're going to do an exercise that I usually do in class in order to illustrate how these budgets work together. So the idea is, with any business, just to give you an overall view, any business needs to start off with a sales budget. How much do you think you're going to sell in your business? And from there, you're going to say, well, if I'm going to sell that much, then what am I going to produce? All right, so here's a nice visual of how that all works together. So from a sales budget, you have to say, well, how much do I need to make in order to have that many sales? So if I have to sell 100,000 units of something, then how many should I produce? Should I produce 100,000 or should I produce more than 100,000? Well, if I'm going to produce that many, well, how much materials do I need now? And how much labor is that going to be? And like I said, and how much factory overhead will that be? We're not really going to get into that piece of it so much. We're really going to focus on these two here. Those budgets together are going to be your build into your cost of goods sold budget. And from there, you're going to have your sales budget minus your cost of goods sold budget will give you what you expect your income statement to look like. Well, and on the outside of this here, you have your selling and administrative expenses budget. How much is it going to cost? So this pretty much follows your income statement straight along. You've got sales minus cost of goods sold, and you have minus selling and administrative expenses, and of course you've got plus minus other income or expenses, but that's not really part of this. You're not supposed to plan for that kind of stuff. And at the end of it, you've got this budgeted income statement. Okay, so they all build off of one another. So we're going to really start with this. We're going to start with the sales budget. And actually, I'm going to start this in a new screencast. So I'm going to say goodbye to you, and I'll talk to you again in 1 second.